Hey everyone, and welcome! In your CA Inter Auditing paper, some topics are practically designed to trap you. And one of the biggest, for sure, is subsequent events. So today, we are going to completely demystify SA 560. The goal? To turn that exam trap into some seriously easy marks. Let's get right into it.
Okay, let's kick things off with a classic ICAI-style case study. Just picture this. The year end is March 31st. You've pretty much done all your audit work. And then, boom, on April 15th, you get a call. The client's main factory and all the inventory inside has just burned to the ground. So, what do you think? Is this your problem? I mean, the audit period is over, right?
Now, if your first thought was, nope, not my headache, it happened after the balance sheet date, I need you to listen very, very carefully. This is one of the most common traps in the entire auditing paper. This is exactly where so many students lose marks, because your responsibility as an auditor doesn't just magically stop at midnight on March 31st.
So this tricky period, the time after the balance sheet date but before you actually sign your audit report, is what we can call the post-balance sheet trap. And it's not some kind of gray area. It's a super critical part of your audit. Let's make this crystal clear so you never ever fall for it.
You see, the standards on auditing, and specifically SA 560, spell out very clear responsibilities for you, the auditor, during this time. You are absolutely responsible for events that happen after the financial statement date. So yeah, that factory fire we talked about, it is 100% your problem.
So, what's the official name for these post-balance sheet events? Well, for your exam, you need to know this term cold. They are called subsequent events. Now, let's dig into the precise definition from SA 560.
Okay, so the definition has two really important windows of time. The first part, and our main focus for now, covers everything happening between the balance sheet date and your report date. But, and this is important, look at that second part, it also covers facts you find out about after you've already signed the report. We'll see why both of these are so crucial.
All right, this timeline right here is your absolute best friend for SA 560. Seriously, you should memorize it. You've got March 31st, the cutoff for the financial year. Then you've got May 15th. That's the day you, the auditor, sign on the dotted line and take responsibility. And finally, May 30th is when the financials go public. The events that happen in these two gaps, between March 31st and May 15th, and even between May 15th and May 30th, that's what this entire standard is about.
Okay, now we're getting to the most important part. Once you find a subsequent event, what on earth do you do with it? This is the core question ICAI is going to ask you. Do you need to go back and adjust the financial statements, or do you just have to disclose it in the notes? Well, the answer depends entirely on what type of event it is.
This slide right here, this shows you the single most important question you need to ask yourself. Did the condition that caused the event already exist back on the balance sheet date? If the answer is yes, we call it an adjusting event. If the condition popped up completely after that date, then it's a non-adjusting event. I'm telling you, your marks in any case study on this topic depend on getting this distinction right.
Let's look at some real examples. Say a major debtor goes bankrupt after March 31st. Why is this an adjusting event? Well, because the condition, the fact that the debtor was in really bad financial shape, that probably already existed on March 31st, right? The bankruptcy just confirms what was already happening. Same thing with a legal case settlement. The lawsuit itself already existed. So for these, you actually have to go back and adjust the numbers in the balance sheet.
And now for the other side, the non-adjusting events. Things like a new share issue, a merger, or hey, look at that, our factory fire. Did the condition for the fire exist back on March 31st? Of course not. The fire itself was a brand new event that arose after the balance sheet date, so you don't go back and change the inventory value on the balance sheet. But you absolutely 100% must disclose the event in the notes to the financial statements. Why? Because it's huge, material information that anyone reading those statements needs to know.
Okay, so we know what subsequent events are, and we know how to classify them. But now let's talk about the auditor's official goals. What is SA 560? And, by extension, what does ICAI actually expect you to do about all this?
Let's just cut through all the textbook language. Your job here really boils down to two things. First, you have to get enough solid audit evidence to make sure that all the events that happen between the balance sheet date and your report date have been found and correctly dealt with, either adjusted or disclosed. Second, you have to know how to react if you find out about something even after you've signed that report.
And that brings us to the really practical part. Because if ICAI gives you a case study, they're going to want to know the how. What are the actual audit procedures that you need to perform to go and find these subsequent events?
You can't just sit back and hope that the client tells you everything. That's not how it works. You need a proactive game plan. And luckily, SA 560 gives you a really clear checklist of procedures that you must perform.
Here they are. These are the key procedures you need to write in your exam paper. First, you've got to ask management what their own process is for spotting these events. Then, you have to directly ask them and those charged with governance if anything has happened. A very, very important procedure is to read the minutes of any board meetings that happened after the balance sheet date. And finally, if they're available, you should review any recent interim financial statements. All of these procedures are designed to specifically cover that critical period up to the date of your audit report.
Now, I want you to pay close attention to this. This is a subtle but really important point right from the standard. It basically says you don't have to redo your entire audit. So if you already checked all the debtors in February and you are happy with everything, you don't have to go back and check them all over again. Your focus is specifically on finding new events. So here's the crucial takeaway from that. Your work during this subsequent events period isn't a mini audit of the whole year. No way. It is a targeted set of procedures, and they're designed to do one thing: identify new events and new information that could affect the financial statements you're about to put your name on.
All right, let me ask you something, because this is a classic trap that so many students fall into. You find a bunch of small errors during your audit, and you think, they're not material by themselves, so maybe I can just let them slide. Well, that's exactly where the ICAI can catch you out. The real answer is a bit more complex, and by the end of this, it's going to be crystal clear. Okay, let's put this into a real exam-style problem. You're in the final review stage. Your audit working papers show two main issues. First, finished goods are overvalued by 2 crores, and second, a 10 lakh freight charge for machinery was just expensed instead of being capitalized. So you can't sign off on that report just yet, right? What is your very next move? This exact situation is what SA 450 is all about. All right, first up, let's tackle SA 450, which is officially called Evaluation of Misstatements Identified During the Audit. You can think of this standard as your official rulebook for dealing with every single error you find, from the teeny tiny ones to the really big ones. The process in SA 450 gives you a really clear 4-step playbook. It starts with step 1. You gather up or accumulate all the misstatements. Step 2, you think about their impact. Step 3, you communicate them and ask for corrections. And finally, step 4, you do a final evaluation before you form your audit opinion. So let's walk through each one. Step 1 is about collecting all the misstatements, but there's one tiny exception: anything that's clearly trivial. Now listen up, because this is a classic spot to lose marks. Clearly trivial is not the same as immaterial. It's a way lower bar. It means an amount that's so small it's just completely and utterly inconsequential. So the rule is simple. You have to list every single misstatement you find, unless it's obviously nothing, and you have to document what you consider nothing. Okay, so while you're adding up all these little errors, there are 2 big red flags that should make you just stop and rethink your whole audit plan. First, if the kind of errors you're finding suggests there's a bigger hidden problem. Or second, if the total of all these small errors starts getting dangerously close to your overall materiality level. If either of those happens, you can't just keep going. You have to stop, ask management to dig deeper, and, this is key, you have to do more audit work yourself to check what they find. All right, next, you got to talk to management. The standard is very clear. You must communicate all the misstatements you've gathered to them, and you have to do it on time. Then you request that they correct every single one. But what if they say no? This is a really important moment. And look, your job isn't to get into a fight with them. It's to understand why they're refusing. Their explanation itself becomes a critical piece of audit evidence that you'll use in your final evaluation. Okay, so management said no to correcting some things. Now comes your final evaluation. First thing you do is look at your original materiality figure and see if it's still appropriate. Then you look at the uncorrected arrows. And here, this is a massive exam tip, so really tune in for this one. You must also consider the impact of uncorrected misstatements from previous years. The ICAI loves this because it checks if you're looking at the bigger picture, the cumulative effect of these errors piling up over time. So what happens if management just won't budge? Well, you don't stop there. You have to escalate it. The standard requires you to go above management's head and communicate directly with those charged with governance, or TCW. These are the people who oversee management. Think of the board of directors or the audit committee. You give them the exact same list of uncorrected mistakes, and you formally ask them, again, to please correct them. And this right here is the perfect transition from SA 450 to our next standard. The very last step in the SA 450 process is to get a formal signed document from management. It's called a written representation. And in this letter, they have to officially state on the record that they believe the effect of all the mistakes they didn't correct is immaterial to the financial statements as a whole. And that letter is exactly what SA 580 is all about. All right, that leads us perfectly into our second standard for today, SA 580, titled Written Representations. This is all about the art and science of getting those critical confirmations from management down on paper. So what exactly is this written representation, or WR as we call it? Basically, just think of it as a formal, signed, I swear this is true letter from management directly to you, the auditor. It really does two main things. One, it confirms their basic responsibilities for the financials, and two, it supports other evidence you've already found during your audit. It's their final official word. Okay, stop and really look at this. This is probably the single most important rule in all of SA 580, and it's where students get confused all the time. A written representation is necessary evidence. You absolutely have to get one. But, and this is a big but, it does not by itself provide sufficient appropriate audit evidence. Let me put it this way. Getting this letter is not a get-out-of-jail-free card. It supports your work. It absolutely never, ever replaces it. So what actually goes into this important letter? Let's break down the essential pieces that you, as the auditor, have to make sure are in there. Okay, so at its core, every single one of these letters has to confirm three basic foundational things. They are non-negotiable. First, management confirms that yes, they did their job of preparing the financial statements correctly. Second, they confirm they gave you everything, all the information, all the access, no secrets. And third, they confirm that every single transaction that happened is in the books. You can see how this forms the very foundation of the whole audit, right? Now, beyond those big three, the WR is also used to get management on record about specific high judgment areas. And this is a fantastic example of how all the standards on auditing are interconnected. You'll need them to sign off on related parties, which comes from SA 550, and on subsequent events from SA 560, and, like we just discussed, on the uncorrected misstatements from SA 450. You see how this one letter becomes this central document that pulls in threads from all these other SAs? Okay, let's talk about the date on the letter, because I promise you, this is a classic MCQ trap. Check out this timeline. The date on the written representation has to be as close as possible to the date of your final audit report, but it can never be dated after your report. And the logic is super simple. The WR is a piece of evidence you need to finish your audit. You can't sign your report until you have all the evidence, right? So the WR will always be dated on or just before the audit report date. Burn that rule into your brain. Okay, now for the drama. This is the big what-if scenario, and you know ICAI loves to test this. What happens when you ask for this letter and management either flat out refuses to sign or they give you a letter that you just don't trust? If they refuse to give you the letter, you need to remember the 3 Ds. First, you discuss it with them. Try to understand their reasons. Second, and this is huge, you have to reevaluate their integrity, which means you now have to doubt the reliability of everything else they've given you. And third, you have to determine what this means for your audit opinion. And trust me, the effect is almost always very, very serious. And that brings us to the ultimate consequence. This is a massive red alert for your exam. You are required to issue a disclaimer of opinion, which means you're basically saying, I cannot give an opinion in 2 very specific situations. 1, if you have so much doubt about management's integrity that you think any letter they sign would be worthless. Or 2, if they refuse to give you the letter confirming those 3 core responsibilities we talked about. In those cases, a clean report is off the table. It has to be a disclaimer. Phew. Okay, that was a lot. So let's wrap this all up with a super quick revision checklist you can use right before your exam to make sure you've got this locked in. All right, for SA 450, here's what you need to remember. 1, accumulate everything that isn't clearly trivial. 2, talk to management and ask them to fix it. 3, evaluate the uncorrected stuff and don't forget prior period errors. 4, escalate to the TCWG if you have to. 5, get that final WR on the immateriality. And 6, document every step. And for SA 580, it boils down to this. Get the letter confirming their responsibilities and supporting your other evidence. Know your 3 Ds. Discuss, doubt, determine, if they won't provide it. And finally, know exactly when you have no choice but to issue a disclaimer. Honestly, mastering these two standards isn't just about passing an exam, it's about making those tough, critical judgments at the finish line of an audit. So think about it. What's the next big hurdle in your audit revision?